Hey traders, welcome to This Week in the Market, our Sunday show. Great to see everyone. Hope you've had a great weekend. Hope you still have a little bit more fun planned before we get into this very rock'em sock'em weekend. It reminds me of those robots, the red and the blue ones where, when you punch one, the head just goes. Uh, yeah, I'm totally channeling my my youth. But yeah, that's what this week feels like. Let me show you why, right? And let's take a quick peek at the economic calendar. As we go into tomorrow, May 1, we saw a pretty interesting end of month, pretty interesting surges. I'll be talking a lot more about that in this issue of This Week in the Market, which will be out tomorrow morning. So for those of you that are subscribers or my Sector Secrets Mastery members, you can access that sometime tomorrow morning. The video has already been posted. You can check that out in the This Week in the Market dashboard. Take a look at May 1. ISM manufacturing PMI. Now, a lot of these hot zones like this probably would be a little bit more, I won't say important, but would be a little bit more reacted to if we did not have two things looming over us. Now, this is an inflation number. So if I were to think about, there's sort of three buckets, if you will, right? You kind of think of three buckets of data that we're always collecting: jobs, inflation, growth, right? GDP, PCE, those are what we're looking at. And when I know I'm a terrible, terrible, terrible artist. I'm even bad at stick people. So, but if I've got ISM coming up, and then I've got, as you can see here, the jolts. Already we're hitting 2 out of 3 of our big macroeconomic important, sort of, if you will, buckets. But why am I going to say they're not as important? There will be a reaction to them, to both of them likely. But remember, on Wednesday, we're going to hear from the Federal Reserve. On one hand, so this is the way I'm looking at it, right? We've always got to think of two scenarios. There's never just one scenario, gang. Just like we set up a target for our trades and a stop loss for our trades, those are two scenarios. In this case, I've got to think about what if the data suggests the Federal Reserve should be more hawkish, or what if the data suggests the Federal Reserve should be more dovish? Hawkish meaning favoring higher rates, and dovish meaning favoring lower rates. We are, and I say we, collectively, we are expecting the Fed to pivot the second half of this year, more specifically, either during the September or November meeting, where we expect to see a rate cut at either one or possibly both, right? That's where we sit right now. So each bit of data, ISM, jolts, we go into Wednesday, we've got the ADP non-farm payroll, which means now we know also, hey, we're counting down to non-farm payroll on Friday. So that's why I say this is a rock'em sock'em week. The thing that we want, and forget earnings. I mean, really, earnings are going to be happening this week. But other than individual stocks making some significant moves potentially, this week, probably nobody cares about earnings. Two ISM releases, ADP non-farm, the non-farm payroll on Friday, and then the jolts, and then the FOMC. Everything hinges, gang, on whether or not Powell does one of two things. And it got me thinking about early March, okay? And if you have any questions, feel free to type them in. It got me thinking about early March, because in early March, and if you recall what was happening in early March, this was before we had the regional bank crisis. On early March, Fed Chair Powell, this was day one of 2 days of testimony. They used to call it the old Humphrey Hawkins testimony, testifying. And on day one, he came out guns a-blazing. He absolutely was about the most hawkish we've heard him in a great deal of time. How do we know that? Because the equity markets sold off. The target rate probability swung way to a more hawkish end of the target rate probability. In some scenarios, we were looking at a terminal rate, which is the highest target rate we're expecting before the Fed pauses, to be nearly 6%. So compared to where we are now, that was a full 100 basis points or a full 1% higher than where we are right now. So that was him on Tuesday. Well, we know what happened by Thursday and Friday. It had nothing to do with the calendar. It had everything to do with what was going on the chart. And you could see it really clearly on KRE. So if we go back, here's our daily time frame on the right here of KRE. Take a look at what happened. And why can't I move this over? There we go. Take a look at what happened. There we go. This was a sell-off that accompanied the Silicon Valley Bank and then the ongoing regional bank crisis, which turned into a general panic across not just big banks, but the equity markets in general. The XLF has since recovered. S&P, NASDAQ, Dow have in many ways recovered from this. Regional banks have not, right? And neither, for that matter, has the Russell. So when people say, Rog, how come the Russell isn't getting the memo? It has everything to do with regional banks, gang. Regional banks and the banking, the finance weighting in the Russell is about 23, 24%. So when you look at the Russell and everything else, remember, it is more bogged down by regional banks than anything. All right, so that was the first week of that week of March. My thinking is we've got to think two scenarios. What if Powell wants to channel the March version? What if he says, look, Fed fund futures and the target rate probability swung wildly because they believed that because of that regional bank crisis, we, meaning the FOMC, the Federal Reserve, had to be less hawkish. My concern is, what if he wants to come back and channel that March 7 Powell and cite the issues with inflation? I'm only putting out these two scenarios. The other scenario is, well, he takes a look at what equity markets are doing. He looks at the data and he says to himself, and this is a really interesting thing that I dive into now in this next issue of This Week in the Market is, and it's a little contrarian an idea, but it makes sense when you think about it in historical context of what a recession does. Is a recession really that bad an idea? Is it that bad to the equity markets? So if we're looking ahead, we meaning all us traders and investors, if we're looking ahead, and I see the question about ZT. This will actually lend itself really well to our conversation. Yi, great question. This will lend itself very, very well. We need to start seeing evidence that either equity markets are saying we're okay with the recession because it's going to do two fairly important things that I deep dive in that report. And then if we start to see those things and come September, November, we could see rate cuts. Remember, if we go into a recession, one of the main reasons the Federal Reserve would even cut rates is because of it. So my argument, my hypothesis is bring it on. Bring on the recession. It'll take care of two problems that we have, and it will create the third as an output, which is the Federal Reserve will have then the justification to, or even the necessity to cut rates. ZT. Now, this is where ZT comes in. Yi, the 2-year note is a really, on top of Fed fund futures and the target rate probability. I know a lot of you see me go into this data before from the CME. If you Google CME FedWatch tool, this is an amazing tool, gang. You don't need to rely on the talking heads to tell you what they think is going to happen with rates. Go take a look at traders who are actually trading this contract, expressing an opinion. There's real money behind this, gang. Someone's going to trade something called a Fed fund futures contract. No different than a corn futures contract, right? It's something that people need to put the initial margin down for, and then they place their bet based on what they expect. We have an 88% expectation of a quarter-point rate hike coming up this week. That's baked in. If they hike rates, there's no reason to say, oh my gosh, the equity market should sell off. We already know this. We meaning the indices and the treasuries and the currencies. We already know this. It's as they say, baked into the cake. It's discounted. It's priced in. What gets interesting is, do we get one more hike? Do we get one more hike in either June or July, or do we hold? So remember, every month after every meeting that we have, in those months, June, July, September, where we are still sitting at 500 to 525 basis points, which is just a fancy way of saying 5% to 5.25%. Every column that's the tallest suggests a hold until we move back down to 475 to 500 basis points, or 4.75 to 5%, which is a possibility, not a probability, in September, but is absolutely expected come November. So if you're thinking, at what point would I focus on the messaging of the Fed pivot? Probably before November. We'll get inklings of that from the September meeting, potentially, based on what we know right now. The Fed pivot, the actual action, comes November. This Wednesday's FOMC and all the data that surrounds it is going to give us, hopefully, some clarity on this. So there's no guesswork, gang. It's all a rate of change of the Fed fund futures, or looking at JOLTS, or looking at ISM, or looking at non-farm payroll, all rate of change. It's not a matter of what the Federal Reserve should do. I get a lot of folks commenting, well, what they should do. Hey, gang, who cares what they should do? It only matters what we think they're going to do, and then ultimately what they actually do, right? That's where the game of trading is played. And then, as I like to sometimes call it, macro navel gazing, and that's by no means a compliment. What happens to a lot of traders is they start to deep dive the data. They go way down the rabbit hole. And you know what's not in a rabbit hole? You know what you will never find down in the macro rabbit hole? A trading platform. Because what happens is these folks start to prioritize their crystal ball macro analysis over, does this information give me a trade? So when you start going down the macro rabbit hole, there's no trading platform down there. There's just more people like that discussing what the Federal Reserve should do and what inflation will do and what's going to happen to the dollar, and then not necessarily the output that we're all looking for, which is a trade, right? Which is a risk managed trade. My two cents. Macro is no crystal ball. And look, I don't mean to trigger folks who love macro. I love macro. I love it, but it has to be used in the right place, right? And this is how I do it. So I love this. Macro is no crystal ball. And this is another thing too, gang. The market is a mystery book, not a crime novel. Stop looking for the bad guy. Stop pointing to central bank members. Stop telling them it's anyone's fault. We don't get to trade markets going, whose fault is this? Get long or short, Jerome Powell is a dope contract. Doesn't exist. I don't think he is. He's doing a job. That's it. Anyway, just make sure you're always standing guard at the gate of your mind, because those rabbit holes are really easy to fall down. Did you all see? It was on Instagram. It was some adventure skier type, and he fell into, basically, I guess it's called a crevice between the snow. I think he's one of those extreme skier types, the guys that ski down the backside of the mountain. And he just went straight down, and there was no bottom in sight. Did anyone see that on Instagram? It was unbelievable. I should have kept it and say, this is macro analyst as we go into May 3's FOMC meeting. He did obviously survive because the footage was, I guess, on his GoPro. Wow, you just could not see the bottom. Whew. So ZT's got to confirm this, right? ZT's got to confirm this. How would it confirm? ZT, remember, like any Treasury futures contract, the movement in the actual futures and the percentage are inverse. If we move higher, that's a lower yield. If we move lower, that's a higher yield, okay? What we want to see, if we're expecting the Federal Reserve to go dovish, favoring lower yields come September or November this year, the second half of this year, ZT has got to take out the 200 propulsion right here, around 103.14. We've got to see movement in price. Price has got to get above that level, and that would be a very good confirmation. So I don't look at ZT a lot, until it's time to look at what it is that I'm expecting the Federal Reserve to do, and what better time to do it when we have such proximity to a meeting. All right. PP Family asks, what are my key levels on the NDX and SPX? So as regulars here, PP family, you know that SPX and NDX are not the best way to understand. Now, I'm not saying anything about trade, not the best way to understand what those two markets are going to do. The best way to understand what those two markets are going to do is to look at the more complete, more 24-hour, more liquid version of the S&P and the NASDAQ. That's going to be the ES futures and NQ futures. Once I know what's most likely to happen there, then that maps to SPY, SPX, or even NDX. So the key levels that I will always look for are going to come from, and it depends also what time frame you're looking at, right? I think one of the most interesting things about trading is the disagreements in analysis that we often have from trader to trader usually results from not being clear when it comes to the analysis about what time frame we are analyzing and what time horizon we are analyzing. So time frame, what's the actual interval of the chart? And time horizon, how long is this analysis applicable? So for example, in this week in the market, I look at a time frame typically of the daily, right? The daily chart where each candle represents one trading session. The time horizon is approximately a week, maybe two, because we have a report that comes out each Monday. So my time horizon, the window where this analysis would be most applicable, most accurate, most actionable would be approximately 1 week. And we just do that every week. Some traders will put out analysis that are basically open-ended targets where, eventually we'll go to 4,500 or we'll go to 3,500 or whatever the number is, right? And they'll just leave those numbers out there. For example, there might be traders out there who say we're going to 4,500. And they might have said it 16 months ago, who knows? And those leave those targets out there. And eventually, one day, if we hit it, they get to go see. And you'll see the same thing with traders, pointing to downside targets. There might be folks saying, hey, we might go to 3,000 or 3,100 or 3,200 on the ES. And they'll, again, leave that open-ended. That's not trading, gang, right? That's not trading. And if you find folks who are doing that without a path, that means they're leaving an open-ended time horizon. Gang, every trader must have a time horizon. There's a difference between analysis that'll just kind of call levels versus, hey, we've got to take this path to where we want to go. Hope that makes sense. So now you know my analysis is going to be session to session or maybe week to week, right? That's about where I'll continue to analyze what we know now as opposed to a week ago, or what we know today as opposed to yesterday. Okay. That being said, not knowing the time frame or time horizon, PP family, what I would say is two things. One, I'm bullish both. I'm bullish both the S&P and the NASDAQ. But that does not mean I'm going to buy where we are. Everything this week has to do with the FOMC. There's probably a better chance we make a little bit of a pullback. I would say there's a slightly better chance, mainly because we've already run up in anticipation of a more dovish Federal Reserve, a more potentially dovish Powell. So if he's not dovish enough, there's a buy the rumor, sell the news, sell off. Heaven forbid he's hawkish. There will be a full-on panic because the wrong narrative was discounted. Yes, the wrong idea was discounted, or it was discounted too greatly. We're expecting too much too soon in terms of those rate cuts from the Federal Reserve. So I'd say that the more vulnerable side we're on is potentially this is a ceiling and we'll move lower, right? And then on the NASDAQ should be a little bit stronger. And in this case, I would look for a buy the dip on the NASDAQ. I'm much more a fan of, we've got an uptrend here. XLK has been quite strong. Microsoft, Meta, all of these really did drive home the fact that, hey, tech is doing just fine. Thank you very much, right? And that's been propelling the NASDAQ and to some degree the S&P higher. Another place to look would be XLV. A fresh uptrend, definitely benefiting from the Q1 to Q2 sector rotation, something we outlined in the This Week in the Market report. And then now, if I get a little bit more weakness, I would love to get long healthcare. Absolutely. A couple other things that I would look for. Oh, we've got Apple earnings, gang. So we know sooner if there is an earnings release that is worth even mentioning, it's going to be Apple. Is there something that could stand up to the hot zones that we have this week and still be relevant? And yes, Apple would be it. And if you take a look at the earnings releases this week, take a look. I don't know why I have Marriott. I don't know why I followed that. That's not something I typically follow. Pfizer, AMD, Starbucks, CVS. This is probably when I was trading Etsy. I really don't trade Etsy that much anymore. So some of these I'll unfollow. They're just not impactful in terms of high concentrated weighted stocks within the more important sector. But here comes Apple, Qualcomm, Booking, PayPal, Disney. We still have some significant hot zones to come, but none as important as, I would say, two things. Apple is definitely the most important. I would say AMD, in terms of its weighting within the SMH, would be the next most important. But we're really on the tail end of those really high concentration weighted important stocks. Apple's probably the end of those really, those mega stock reports. So Apple on Thursday, it's the day after the Federal Reserve and the day before non-farm, here comes Apple. So NDX, because of that, there's a big, look, if I'm trading the NASDAQ, whether that be QQQ or NQ or NDX, remember, we might travel between now and Wednesday, 2 p.m. We see what Powell says, and then we go into Thursday. When we have this much proximity to major events, shorten that time frame, shorten that time horizon. You all know what that lingo means now, right? Shorten it up, because you want to be able to get in and hopefully get out before the event. The flip side of that is also applicable. Lengthen the time horizon. And I don't mean a daily, I mean a weekly. So if you're going to shorten the time horizon to make it so you can just be ninja quick, get in, get out before these events, the alternative is a weekly type approach, more of a position trader, more of a portfolio position, where the weekly time frame can a little bit more likely absorb the volatility of FOMC, of non-farm payroll, of earnings, right? That's the other alternative. So think about time frame and time horizon. That's going to be a big part of how we're going to process what happens next. And what happens next is going to be really, in many ways, almost solely dependent on the tone that Jerome Powell takes in the press conference during the Wednesday FOMC meeting event, right? Everything gets released at 2, and then we've got the initial reaction. Then we have the press conference that starts at 2:30. All right, next up, let's see. Praveen, you can't find the video? Let me see. If you log into the website, let me go do that right now. So where you would find it, whether you're a Sector Secrets Mastery member or you just signed up for the newsletter, head on over down to the This Week in the Market report. All right, and then premium daily videos, and there it is. All right. So when you get to the dashboard for This Week in the Market, let me try that again. You go into This Week in the Market. Let me try that, make sure. And then you go to premium videos. Yep, and there it is. Okay. So it's posted. Mr. Walker says, thank you for showing me the oversold buy strategy. I'm now working on my trade psychology. I see a way out, but not there yet. Yeah, Mr. Walker, everything's a process of turning the corner and dealing with the market that we have. And as long as you're starting off with a neutral market environment, use the Darvis 2.0 to automate those support and resistance levels, and then use that slow stochastic. It's a free process. It's one that I've taught for many, many years. It just works, as I'm sure you're seeing. But we've got to make sure it's a non-trending environment, right, Daniel? Exactly. Play the cards in your hand. Play the market you see, not the ones you wish you had. Absolutely. Absolutely. All right, good stuff. Yee says thanks to ZT. So Yee, I would say anytime we want to measure the Federal Reserve, anytime we want to ask ourselves, what are the other markets that are confirming that dovishness or hawkishness? Fed fund futures are one way to do it via the target rate probability site that I show you all, and ZT is another. It's probably a better barometer than say the long bond. I love watching the long bond. I absolutely do, and I love watching the notes ZB and ZN. But ZT is the one that I think is going to be really important. And then also, I would say ZT, and then keep an eye on gold. Gold could be very interesting because gold right now is sitting at a level that would suggest a little bit of uh, not indecision, but definitely wait and see. It's that gray line cutting across the chart. I use really important yet basic, non-custom, non-techno babble in the newsletter. If you're an experienced trader, no problem. You're going to have well watched, well reacted to, well respected levels based on volume and price and so forth. But if you're brand new to the market, it's equally going to make sense because I'm not going into cutesy custom indicators. I've got them, right? But I'm using things that the broader markets are making these bigger decisions based on. One of those things is the point of control. Not only is it a powerful way of looking at support and resistance, it is also indicative of the single price level on a chart that tells us where the most volume was traded. Why would we care about that? Because where the most volume was traded tells us a lot about what's happening in terms of attention and size, right? Volume is size, and where there's size, there's attention. So that's definitely something that I would look at on any chart that I'm, for example, let's take a look at Apple. If I take a look at the 2023 point of control, interestingly enough, and this is actually really cool, the 200 propulsion, meaning this is an indicator that goes really, I think, it transcends technical analysis, because even folks who think a chart is what you find next to a sunken ship at the bottom of the ocean, that's what they think the value of a chart is. Lo and behold, they know where that 200 is, or where the 50 is crossing at 200, or we get a golden cross or a death cross. So it's incredible where there is a single indicator that almost everybody knows to watch, and it's the 200. I like to use the exponential. The simple is fine too. They're going to usually be in a similar vicinity. But I've got that really well-watched indicator, and that's also where the most volume is. I'm not saying that's where Apple goes, but there's a lot of folks either making money above that level or losing money above that level. There is a lot of attention and size right here. All right. So that's definitely something to keep in mind as you take a look at the chart of Apple. Let's see, what else do we have here? Can I go over how to trade opening ranges? Glenn, I did a little bit of that. Well, no, I actually traded a hot zone. So yeah, I haven't been doing opening range breakouts in some time, not since we've gotten as choppy as we have. Opening range breakouts work usually a lot better in trending environments where there's a tendency to continue higher or lower. So I would wait until we have better clarity in the daily time frames for a trend before I start using that again, before I start looking at for those opening or clearing range breakdown setups. They've been on the back burner in the rooms when I'm trading. I haven't been using them for, gosh, probably 6, 8, maybe 10 months now. So that's still on the back burner until daily time frames, that path of least resistance comes back, which actually, Glenn, if Powell is clear about his dovishness, whether it's now or June, we could get that. My pleasure, Jack. I really do enjoy doing this, and I hope that traders get a feel for, hey, there is homework to be done. Sunday's a great time to kind of chill out and spend maybe 30, 40, 45 minutes looking at things that'll have us better prepared for Monday. Absolutely. Does the fear of recession still exist? I don't believe so. No, I don't believe so. I mentioned a little bit of that on the onset of the show. You might want to check out the replay. Matt says, I just subscribed to This Week in the Market. Very cool. Can we get a look at gold and gold implications? Yeah, Matt, I would tell you, go back into the archives. I do have gold on this one, but the deep dive that I did on gold, and I probably at some point need to go through some of the archives. But yeah, I do have it. Believe it, actually, it's funny you say that. I do believe I have a gold chart in this week's update, but I would actually go back, and if you haven't already, check out the issue for, I believe it was April 7. Yeah, go back and check out, I think, let me double check here. If it was April 7 or April 14, I did a deep dive on gold, and that one might be one you want to check out. Let's see. Yes, check out the April 14 issue. Yeah, Matt, I did a deep dive on what it is that's going to make gold move next. And in this update, I've got some levels on gold to take a look at. But definitely check out. On some of these, I go into professor mode and I start to talk about different things that help us understand real yields and gold. And for example, I went into that that issue, Matt, is the correlation between gold and real yield explains why inflation is gold's best friend, while rate hikes are its worst enemy. Right? So gold loves inflation. It hates rate hikes, right? And I did go into that a little bit in this issue, which actually I'm looking at right now because I've been working on it over the weekend. All right, gang, as always, thank you so much for being a part of our Sunday show. This Week in the Market is available. I'm going to go, I think I've got thisweekinthemarkets.com. I'll go forward it to the sign up page. Y'all can take a look. I'll do that tonight or tomorrow. So eventually all you need to do is go to thisweekinthemarkets.com, plural. In the meanwhile, you can, now we just finished the sale. I don't think it's available, but there are some other deals to be had. If you go to simplertrading.com and you go to memberships, you'll see under memberships, I just don't want you all to dig through the site. If you go to premium reports, and let's see, there it is. You can check out the trial. Okay. All right, gang. As always, I will talk with y'all soon. Be good to each other. I'll see you tomorrow for Charts and Coffee.